Well, greetings everybody, and welcome to our special edition of Turnout Tuesday. We've entitled Cognizant Nation, and we'll cover a little bit of ground on that one. My name is Mark Robertson. I am founder and managing partner of Manifest Investing, one of the sponsors of these sessions, and I'm joined here by my dear friend Ken Kavula. Ken is a national educator for the National Association of Investors and has been very active in volunteer leadership and frankly he just loves rolling up his sleeves to teach classrooms full of people. So good evening, Ken.
Good evening, Mark. I love your lady with the cup of coffee, and I really enjoy the quote that goes with it.
Yeah, I think that applies to a lot of things in the investing world. I mean, there's a lot of people on TV, saw a few of them this afternoon, that somehow think the world is coming to an end. And, a little bit of interest rate action by the Fed, and they're all panicking for some reason. And, next thing you know, the market's up 430 points. So, well, we've been titling these sessions Turnout Tuesday just because we're happy for the turnout, and it's just an opportunity to not watch TV and go and do something. Ken was saying in the green room just a few minutes ago, we often end up in places we don't expect to end up, and this is one of them. We're going to talk about Cognizant technology. And as I recall, Ken, this is a pretty widely followed stock and widely held stock by our community.
Well, yeah, Mark, we surveyed the model clubs about 3 or 4 years ago and found out that the Cognizant was held by every single model club that replied to our query except for one, and the one happened to be one of the Mid-Michigan model clubs that didn't hold it at that time. It holds it now. Even our most recent survey of about a year ago showed that almost all of the model clubs still hold Cognizant technology. So it's a very popular stock, but there's a lot of concern about it right now.
Yeah, I don't know how often it came up in your sessions in Chicago at the National Convention, but I fielded several questions on, do you have concerns about Cognizant technology? And I said, yeah, I haven't really dug into it too deeply yet, but there are some things that are giving me angst. And I talked to a few people who do follow it fairly closely, and they confirmed my suspicions, and I wasn't imagining things. So we did promise many of the attendees in Chicago that we would be taking a closer look at it, either at a roundtable or at this session here tonight. So that's how it ended up here. All right, let's go ahead and get the legal paperwork out of the way. You guys all know the drill. No investment recommendation is intended. This is all about the demonstration of the philosophies and principles, analysis techniques and methods of the National Association of Investors, also known as Better Investing, also known as investment clubs, also known as the Modern Investment Club movement. Manifest Investing is faithful to the principles promulgated, I like the word promulgated, by George Nicholson Jr., the grandfather of the Modern Investment Club movement, and we simply try to find ways of implementing those philosophies, modifying them, and being logical, but trying to stay true to them. Tonight's an example of one of those things, I think, as we get into it a little bit deeper. I think both of us hold shares in at least one account each, and I know Ken in his 19 investment clubs has a few shares of Cognizant sitting around, so.
I'll tell you, Mark, Natalie and I have owned Cognizant since the late 90s. It was one of the first stocks that she and I ever purchased as a couple, and we purchased it when we came across the word outsourcing. Flint, Michigan was the epicenter of a lot of the initial outsourcing that went on in the auto industry. And my wife and I both became intrigued by this whole idea of outsourcing, taking jobs from one location and relocating them elsewhere. And we were looking for an idea to help us turn that into a little bit of investing cash. Cognizant fit the bill. At the time, it was a fairly small company doing most of its work from India, running call centers and the like, and generally serving as a support to a lot of different industries. Today, it's a much larger company, obviously, and it does a lot more work in a lot more different places, and is having some growing pains. It's also facing some quite a bit of competition from a fair number of other companies that are trying to emulate the success that Cognizant has shown over the years.
Yeah, I first became aware of them back in the late 1990s, also in the management consulting realm, and witnessed them doing some pretty good work. And that's obviously a pretty good chunk of their business. But it is an area, as Ken was just saying, that's we're going to talk about. It's definitely an open invitation to some competition. Just a real quick reminder, if you have a friend or a family member who'd like to be reminded about these webcasts, you can send an email to ncavola1@comcast.net via the email address on there. And if you have questions, would like copies of the slides, or just have follow-up questions, Mark R. at manifestinvesting.com. So with that, let me switch us in. Here's our agenda for tonight. I put the lady with the coffee cup back on the page along with Mr. Chaos, Jeff Goldblum, and a little definition of cognizant there. I think we all know pretty much what it means. It's just basically to be aware, to be acutely aware, or hip to, and all that kind of stuff. So again, welcome if you're here for the first time. Extra big welcome. We do try to keep these informal. If you have questions, you can enter them in the questions tab. If you'd like to speak over your microphone, you can raise your hand and Ken will be monitoring for that. So again, welcome, and let's keep going here. This is mostly about Cognizant technology and a little bit of vigilance, a little bit of deep diving into things that are going on. We're going to talk about gaps, flavors of gaps, and a couple different kinds of gaps to be mindful of, and this notion of resistance, a little revision of expectations, and then we will try to leave some time for open question and answer. So let's start with the picture. The big picture as presented by Value Line. There's a few things that we take away here, starting with those two arrows in the middle of the page. This is the first gap we want to talk about, this one that's depicted here. The stock price has basically gone from a high of 85.1 to a recent low closer to 56. So it's actually dropped down on the chart here. Now this line that actually runs through these price points and actually has a deflection out here where I color coded in green is known as the value line. They think that's basically a fair price for the company. So the fact that Cognizant technology has gapped down well below the line, this gap that you see right here, suggests that it's potentially on sale. That is confirmed by these return forecasts over here on the left. And we just want to notice that's the situation. We also want to notice that if we went back and checked, we probably would find that they've adjusted their price to cash flow ratio. This 15.5 has probably gone down. I know that because the slope of this line has changed ever so gently. These are all things that we want to notice. And then down at the bottom of the page, this is what's causing some of the angst. These numbers are a little bit more timid than they've been in years. Those are the sales forecasts for the end of this year and the end of next year. And if you look real closely, these profitability figures as measured by the net profit margin, which had been hovering in the 15 to 16 range, are suddenly in the 13 to 14 range. So that is suggesting more competition or some challenges when it comes to cost control. What else can we think of when it comes to something like this, Ken?
Well, there's a number of different things that a company can do when this thing is happening, when these net profit margins are shrinking up. But I think you hit the two biggies. It's a little bit worrisome to me that with that huge tax cut that just occurred, that net margins, while they moved up in the year that the tax cut was realized in 2018, they've dropped precipitously. We do have a brand new chairman on board, and sometimes new management can can drive profit margins in the wrong direction. But there's a lot of things happening with this company right now that, and not all of them are explainable to me, at least.
Yeah, and some of the stuff I read, we don't need to go too deep into it, suggested that there was an activist shareholder a couple years back that may have forced them down a few paths that probably were not the best ROI type areas. That was just basically some of the criticism that I saw as I was digging into a little bit deeper. Here's a look at the company. Basically, a look side by side at the conditions as they were 1 year ago. Again, most of these numbers are straight off a value line versus just 1 month ago. And you can see that the stock price had dipped down from the 80s down to the high 50s as of May 10th, basically right around the time of the National Convention. And you can see that growth had moderated a little bit. The forecasted growth had moderated from 9.5 to 9. And there were these projections that the profit margins were going to be coming down a little bit, but lo and behold, Value Line was still coming in with a 22 PE for the company, generating these really nice looking picture of 20%-ish type projected annual returns. And you can see that the year-over-year situation for that low forecast that we showed on that first slide, pretty robust. So again, the situation is we saw the 2 points for sales. Some of us refer to this as kind of the case of the Benz. It's not a deep case of the Benz, but basically what you see is some deflection of that long-term trend as those sales expectations for 2019 and 2020 are getting a little softer. So think of it as deflecting the long-term trend in a lower direction. And then, of course, the other one that catches our eye is these two earning forecasts for this year and next year are definitely not on that long-term trend. They've been deflected downward. And we know that anytime that happens, the price becomes vulnerable, because we do believe that with some time and enough time in the oven, stock prices will follow earnings. So again, as a community of investors, when we see this type of a forecast unfolding, we just simply shouldn't be surprised by sluggishness in the stock price. So in picture form, the 2019 and 2020 net margin forecasts are definitely lower than they've been. They got kind of down there back a few years ago, but they've been doing a few things. Obviously, as Ken said, there's probably some tax effect right there, and just kind of troubling that that's just a little bit of slippage, and it's not just all maturity. There could be some potential slippage in there. And,
Mark, Marianne pointed out also that there's a modest increase in shares, and that's kind of atypical in today's market. And if that trend should continue, that will contribute to some issues as well.
Yeah, while the average company has dropped their shares outstanding a few percentage points, this one obviously actually went up a tiny bit. Good point. Thanks, Marianne. And again, the PE ratio probably deserves to be somewhere in the teens, and you can see that Value Line is kind of stretched out here to get to a 20 something. I'd have a tough time supporting that just based on the track record of the company at this point.
Mark, Joe is making the point in the question box that Value Line indeed has dropped the cash flow multiple from 16.5 down to 15.5, and he thinks it had been at 16.5 at least back to somewhere in 2013. So for a fairly long point in time, that cash flow multiple, which helps measure the slope of the Value Line, was higher than it is in the current Value Line.
Yeah, so they're looking at it, they're trending it, they're doing the same thing we do when we study our companies, and that's the conclusion that they obviously reached, that it was time to ratchet it down a little bit. All right, so let's take a closer look at concern number one. This is actually off of the Value Line report from a little over a month ago, and you can see that the first quarter was disappointing. They came in short on revenues. Some of that could be global recession. Some of it is failing to win some competitive contracts, perhaps not renewing some. I can think of one here fairly locally that they didn't renew the whole contract. So it does happen. And you can see that they see weakness in financial services and healthcare. My experience and exposure is that the healthcare consulting is going pretty well. So if they're struggling there, that could be telling. So the shortfalls are listed right there for you. Everything came in a little bit less than expectations, and investors were not shy about registering their dissatisfaction. Taking it a little bit further down, notice that they are moving their sales growth estimate for the 3 to 5 year forecast down to 7%. When you take a closer look at the data on the stock selection guide, and this number here happens to be from Finance Yahoo, so it's the analyst consensus estimate. It's actually a little bit more optimistic by a couple $100,000 than Value Line. You still end up with a regression where the slope of that red line is approximately 7%. So this is a company that not too long ago was in the 10 to 12% range, and now we're looking at a picture for the next 5 year time horizon closer to 7%. Any comment or question to that, Ken?
We have a hand in the air right now. Let's see if I can unmute the person. No, it maybe was inadvertent because the hand's gone down. So we'll continue, Mark, okay?
One of these days we're going to have to start a tracking thing on inadvertent hands.
All right.
All right, so just another quick look at the profitability. This is a major aspect of what's going on. We see that the projected net margin is weaker for 2019-2020 and projected to pretty much stay down there over the next 3 to 5 years. That obviously causes this indentation in earnings, and we would, of course, expect the stock price to somewhat follow that in some way. Now, as you read up on the company and digging a little bit deeper, we find that they're finding it challenging to stay at appropriate staffing levels. They probably had a few more people on staff in middle management in less billable positions. So all that adds up to some costly issues. So this is the Value Line close at the top half of the page. And you can see that they actually have a significant opportunity. Our friend Pat actually works in digital transformation for Accenture, so we know the type of activities that he's been involved with. But there's sizable opportunities out there, and if they're not capturing them, that would be some cause for concern. So,
Mark, Dennis is making the point in the question box that the largest firm that competes with Cognizant is called TCS, and it's in India, and it only trades in India, but it's by far the largest with 424,000 employees. The next biggest one is Infosys, and we're very familiar with Infosys. INFY is that ticker, and that does trade in the U.S., and then Cognizant is in there at about the same size. So there is some competition for right in India, where Cognizant does a lot of its business. Cognizant also does business in Eastern Europe, so it doesn't have all of its eggs in the Indian basket, but it certainly has a lot of business. That hand has gone back up again, so I'm going to unmute Ann, and Ann, go ahead and ask your question.
Hi, yeah, it was me. I took it down because you went on to something else. Can we go back to the Value Line page where you first showed it? Okay, if we're not looking at anything other than just that page and not what you've talked about since then, would we not consider this a triple play?
interesting question. Yeah, the return is now, at least this page, on this page, we're looking at an average return of 20-ish, a low of 15. The stock price is down. The PE is 14.9 versus an expectation of, even if this is slightly optimistic, it's still an increase. And we are looking at, and this is where the weakness might come in just a tiny bit, in slightly higher margins. They're actually not higher than they've been in the last 5 years, though. So it would be a little bit weak on that third leg of the triple play. Is that the way you'd see it, Ken?
Absolutely, and I want to make clear that I've heard a lot about triple plays in the last 2 or 3 years since you and I start noting that a lot of great companies are sitting at triple play circumstances for us to look at. Triple play just means that it's a great company we should maybe move to the top of our let's study list. It does not necessarily mean it's a great buy or it's a great opportunity. It just means that it's something that we should probably study sooner rather than later. And Nicholson used language like the chances are much greater that you'll find a good candidate when you're looking at triple plays. But nothing in and of itself makes a triple play a great candidate. There maybe are a few more of them on that triple play list than those that aren't, but for the most part, it's just telling us, take a look at me. I'm very intriguing. Find out what you can about what's going on. That's the lure of a triple play stock in my book, at least.
Yep.
Okay, I agree.
Yeah, and
Okay.
I think
That was my question.
it truly is a probability stack, and you're right, Ann, to point it out. It's this one is 2 out of the 3 are pretty much a slam dunk, and the third condition is not bad, especially when compared against in the context of the total sub industry. All right, so again, back to the situation. Ken said the chair is new, the CEO is also new. So he's only been on the job for a few months, and that might explain a little bit of what I'm hearing as far as sharks in the water, and maybe there is a little bit of sniping to try to take away some of their business while he's getting his feet on the ground. But it really is it's been such a solid company. It's easy to imagine that Cognizant will rediscover the tracks that they've been on for years, and that's kind of the basis of the entire value line thesis on the company as presented by Charles Clark here just a few weeks ago.
Mark, Dennis is making another point, and it's certainly a great point to make, that all 3 of the firms that we talked about just a few moments ago that are competing with each other make most of their money in the United States. They don't make their money in India. They just have a lot of their employee base in India and do a lot of the work itself in India. But the profit is coming from the United States. TCS, for example, makes a half or more of its money right in the USA. So we're not talking about companies that making all their money overseas and with overseas employees. We are talking about companies that make a significant amount of money right here in this country.
Yeah, in fact, Cognizant is headquartered in New Jersey, with obviously with operations in India. So yeah, that is the situation. They do have enough, almost all of these companies that do have quite a bit of international content that makes them, I'll just say, responsive to the recessionary conditions around the globe. So there's that too. But yeah, they make a significant, material amount of their business in the United States.
Mark, we're getting another pretty good observation / question, and while you have the chronicle up, maybe we can address it. The question is, do you perceive that the quality rating on Cognizant will start to deteriorate as the profit margins and the growth in sales get lower?
I do. If there is erosion at a pace more rapid than the industry, yes. Absent any other changes to the business, you could see Cognizant trail off a little bit. It's one of the beautiful aspects, at least from my perspective, of the quality ranking itself. It is truly unemotional. It's very quantitative, and it just don't lie. It's if the balance sheet is getting weaker, if they're losing competitive position, it ultimately will be reflected, and I think it gets reflected fairly quickly as that type of a situation would begin to materialize. Would that be your expectation also, Ken?
Absolutely. If profit margins are going to run down, I know that one of the four pillars of quality is relative profit margin compared to the rest of the industry, as measured by an industry average. And if Cognizant's profit margin is moving down without a corresponding move downward in the entire industry, the same thing true for its sales growth, I would expect then that I'd see quality rating begin to deteriorate. Remind myself, however, that it's deteriorating from about as high as it can possibly be. It's deteriorating from a 99. So it might go down to the 90s or the 85s even, but it's still going to stay a very high quality stock, I think.
Yeah, they have a rock solid balance sheet and pretty well positioned across the board. So here is a look at that. This is the sub industry. It's not the entire industry. Top in the information and technology services industry, and I'd refer to this as a sub industry. Again, in addition to the companies mentioned by Dennis, you do have EPAM, you have Infosys down there, you have DXC. That is basically the old computer systems or computer. It was CSC. I don't remember the exact.
Computer science, I think, was the name of it.
Science, yeah, you're right. And they're actually taking on Luxoft Consultants, also a company that has been showing up on our screens for quite some time now. ACN is Accenture, and CACI is another consulting firm. So again, you can see the prices. The second column is their trailing sales. So as Dennis was saying, we are talking in Cognizant and Infosys, you're talking about two of the bigger ones, but we do have quite a bit of revenue from DXC, and Accenture is actually the largest one on this sheet when we're talking about these consulting firms. EPAM is actually our number one small company for this year on the list, which probably carries some type of a Sports Illustrated cover curse with it or something. We'll see. But they are the smallest and most nimble in the group, and they do end up at the top of our rankings. You can see that the growth rate is up in the high teens or the 20% range, whereas everybody else is in the high single digits. Here are the net margins for the companies side by side. So you can see that Infosys is the leader in profitability, but everybody's cranking away pretty good, and Cognizant comes in a pretty solid second there. The projected average PE is this column, and again, EPAM is an early life cycle company, so elevated PEs are part of the whole story. I do find the DXC PE to be fairly interesting. I mean, this company is not behaving like this peer group, and I think I'd be compelled to dig in and study that a little bit harder, because even with that lower PE, check out this return. And I just find it very interesting going across the board. Now they do have a little bit lower quality, so it'd be an interesting study to kind of dig in and see how these business combinations with Luxoft and everything is falling into place. And they are trading very close to their 52-week low at 1.4% above the 52-week low. Value Line likes them. They have a high owner's return on capital. And these are Buffett-like numbers when he goes shopping for companies, to be down at basically half off on the price to fair value ratio. So that's kind of a compelling study for me. I might actually rake that one over the coals a little bit better, perhaps in combination with EPAM. And it just gives you a kind of a cross-section for this sub-industry. Anything jump off the page at you, Ken?
Well, we're getting a comment, Mark, that the DXC quality in the top graphic doesn't come close to matching the quality in the bottom graphic, and I'm just guessing they were captured at two different times in 2 different days.
That's
yeah. So I'm not sure why they would move so much in relatively short time, but it is what it is with the screen capture. I really like to study, 2 or 3 at a time, and I'm in 2 clubs where Cognizant right now is being put through the paces in a complete industry study because we would like to continue to own the best. And for many years, we were convinced that Cognizant was the best in the industry. And now we're having some, I guess we're just doing some due diligence to make sure that still is the best in our opinion. That's all we're doing.
Yeah, we're in the middle of an update of DXC, so that's probably what happened there. And that the conversion and the inclusion of Luxoft is a big deal. All right, so here is again just an example of digging a little bit deeper. So every once in a while we get questions about trade journals and looking in places other than Value Line, S&P, and the normal stuff that we look at. This happens to come from a publication entitled Economic Times. And it gives you a little bit of an inside look at some of the challenges that they face. And I worked in this field, so I know what a challenge, manpower profiling can be. And they're just giving you a little look that they apparently were a little bit heavy on the middle managers. And these are typically the account assignment, often the client development or client relationship managers that deal with these companies. And if they reach too high of a percentage in the total profile, it can be a little bit uglier cost situation. So that's what you're seeing a little bit of talk about there. And then Humphreys, the new CEO, talking about some of the things he's thinking about in terms of investing in the business that is Cognizant Technology. And you can see down at the bottom, he's talking about various aspects of taking care of the portfolio of business. So again, that's just an illustration of how digging in to a trade journal sometimes can help you understand a little bit more about what's going on under the hood. All right, we'll keep going. So with that, what we'd like to do is compare side by side with, where was this company a month ago in light of some of the stuff that has come down even in just the last 30 days, less than 30 days, 2 to 3 weeks. The stock price is pretty much where it has been, but based on the graphic that you see here, it's pretty easy to make a case for a 7% growth rate, not versus a 9. So 7% for a growth rate. I have a fairly easy time coming up with profitability somewhere in that 14 range. Wouldn't quibble too much in any direction here, but 14 does seem to make sense. And the third judgment milestone that makes a big difference, PE. I have a hard time coming up here to this one, especially knowing what is going on in this particular operating environment. With these companies, they're competing fairly aggressively with each other. And anytime the net margin is sliding down, the sales growth forecast is sliding down, the company's maturing, it's pretty hard for that PE ratio expectation to be ratcheted up as it's been done here. So what you're seeing here is a slight reduction in that. So using those 3 assumptions, you get a pretty different picture. Not a 20% return, but something down in the 10, 11, 12% range for the company with, I think, what are fairly reasonable expectations going forward, looking at the operating environment. Anything you'd like to add to that, Ken?
Well, usually when we do a call of this type, we're coming up with a projected annual return, a par value that comes very close to the Value Line low total return. And you'll look at that number right under the 11.2 that Mark has a check mark next to, and you'll see Value Line is calling its low number around 12.9. I would suggest that if Mark were to raise his PE to 17.5 or 18, or if he were to raise his net margin to 14.25 or 14.5, or range his sales up a little tiny bit, that he'd be right on top of that 12.9 number. So I think that there's validation in the method that we're using. When our value that we calculate from basically a simple balance sheet when it comes out and it's very, very close to the value line low total return. In other words, that 11.2 and that 12.9 are basically, in my book, the same number, and that's good.
I would agree with that. So it's, you know, that's still not a bad opportunity. I want to be clear about that. I mean, this company has a fairly significant material challenge in front of it, but that's a pretty decent return, any way you shake it. So with that, I'd like to go ahead and launch us into a little different perspective. Ken confessed a little bit earlier and said that I've been sneaking off to a technical analysis presentation. Went to one just last night. There were actually some better investing people in the audience too, with a bunch of American Association of Individual Investor people. Presentation put on by Ray Rondeau. That's his quote on the lower right. And he kind of kicked things off knowing that his audience is predominantly fundamental investors. And most of us wear that hat. But one of the ways he kicked things off, and I think, Ken, this plays right into something you've been saying for years, you have to be willing to think a little bit differently sometimes about some of this stuff. Are you
Absolutely.
ready?
I'm with you, Mark, and absolutely, and I'm the greatest proponent of telling anybody that wants to listen that I believe that a lot of technical analysis is facts that are concluded after the answer is already known. It's kind of like the seventh grader that goes to the back of the math book and looks up all the answers first and then tells you what the answers should be. But I think that technical analysis has its place because so much of the market is controlled by non-individuals, by institutions. And those institutions believe in technical analysis, and so it kind of becomes a foregone conclusion that if enough people believe in something, then that's what's going to happen in the short term. It might not bear out to be the truth in the long term, but in the short term, people are going to believe what they're told. And when you have huge numbers like we have in today's market, believing that technical analysis works, then it's a self-fulfilling prophecy. It will be true because enough people believe it will be true. I'm depressed when I say that, Mark, but at the same time, I recognize what's happening.
And to the audience, you guys have no idea. I mean, when I first brought up any notions of technical analysis, I don't know, 5 years ago with you, Ken, when it might have been more than that, 5 to 10 years ago, I think what might politely be called a pushback. I think we were probably going 50 miles an hour down the road, and the door came open and you just pushed me out. No, I'm just kidding. But no, the reaction was like it is with so many of us, because I share the concerns. But I'm also willing to take a step back. What Mr. Rondeau was basically saying, Ray was saying, just be willing to accept this as a reality. And he says, what I just heard Ken say is something that we hear many people say. It's just a self-fulfilling prophecy. And Ray's answer to that would be, okay, you know, why are you struggling with that? What it is basically doing is we know that there are these institutions out there. They have all these computers and machines. They've got all these algorithms. They behave certain ways. So yes, there are certain conditions that are going to be what you might almost think of as self-fulfilling. So don't criticize the technical analysis, because it is telling you where they've been. Doesn't necessarily tell you where they're going, but it does give you some hint as to, you know, what type of things might happen coming at it from this characteristic. And the ferocity and the intensity of some of this activity is it's at a much higher level, and it's becoming more reliable. It's just something that we don't want to pretend doesn't exist, because it's out there. So with that in mind, again, with underscoring this notion that the retail investor of 1950 is not it's not the same population in the year 2020. there's been quite a shift. So with that, let's go
And
ahead.
for the 3 or 4 smart alecks in the question box, no, I was not investing in 1950. Okay.
And I was just a twinkle at that point, so no, I wasn't here for that either. All right, so let's take a look at a quick look at stock charts. And what I found fascinating about this one, I went looking for stuff on stock charts specific to Cognizant Technology, and I found that Ty Hughes, he's one of the directors, volunteer in the Washington, D.C. chapter out east. He attended the National Convention in Chicago in mid-May. He actually made up a watch list of charts based on the stocks that were mentioned or discussed. And in fact, he was among the group of people that talked about possible notions of angst with Cognizant. So I'm digging through, and I actually find that he has saved this chart. Now, I added the verbiage from the reference down at the bottom of the page, and we'll go through that here in a minute. But what you're looking at is a 1-year chart, a price chart for Cognizant Technology. The prices that are depicted are daily price bars, and from left to right, you can see that it's been a pretty significant downward trend. Now, one of the major things that the institutional investors, again, they're in the majority now, will actually track and follow fairly carefully is this notion of the 200-day moving average, which is basically a year of investing transactions, versus the 50-day, which is basically 2 months. The 2-month trailing average is in blue. The 1-year trailing average is in red. And what they'd watch is the relationship between the two. And anytime the 50-day, the more volatile of the two moving averages, trailing averages, crosses the 200-day moving average, they refer to that as, well, first of all, a cross, and then some refer to it as a death cross. So at this point here where the big arrow is, again, you want to talk about self-fulfilling or foregone conclusions. A whole bunch of institutional investors were going to sell this company. Lots of them. And for some period of time. And that explains a lot of what you see going on, in this time frame here. It hit the point where the 50-day moved through the 200 as shown by the arrow. So again, for any stock that we're holding, and this kind of circles back beautifully to some of the stuff we've been talking about as far as capital preservation, we'll come back to it. But I think it's a condition that we want to remain fairly aware of. Anything you want to add to that, Ken?
Well, no, except that I'm eager to discuss the gap over on the right-hand side of this graph, because I think it has some meaning that we can conclude on. In our discussion before this broadcast, I said to Mark, well, this might be the trigger that we're looking for to help us preserve capital for long-term holdings, especially for long-term core holdings. And I might say to myself, when I have this death cross happening right here, that Cognizant would move from my core holding pile to my non-core holding pile. And then I have different guidelines that I use for selling core holdings versus non-core holdings. Core holdings, stocks that I can feel that I can legitimately hold for the next 5, 6, 7 years. I won't sell until their par values reach money market returns. But non-core holdings, I'm much more likely to sell once their par values reach levels beneath average. So if the average stock is going to return me 8%, and on the time of the death cross or somewhere near after, Cognizant's par moves down to 7 or 6.5, that might be enough to nudge me towards a sale. And then to reevaluate the company when it moves into a buy again on my stock selection guide. We refined that a little bit in our discussion before this broadcast, but I'm going to turn it back to you, Mark, to talk about what's going on between the big red arrow and the gap over on the far right there.
Right, and whether it's switching from core to non-core, I maybe in honor of the Stanley Cup playoffs, I think penalty box myself. Put it in the penalty box and decide what you want to do with it, what type of penalty you want to assess. But yeah, I think it's definitely something we want to be aware of, and we'll be posting some information on that here fairly soon. Now, the other major characteristic, there's three on the chart. The second one is anytime there's a price gap between the closing price from one day to the opening price to the next day, and when the stock price is trending downward and you get one of these, that's a pretty nasty moment. The institutional traders will react to that with some negative selling pressure fairly reliably. So you see those, and these are the red circles that I've made here. With that gap, you notice that the price continues down. Now, again, these are not major drops, but this one is fairly significant here. But what happens is you basically have an overreaction. Much like Ray was saying, this pendulum swinging too far the wrong way. Volume will pick up, and this type of thing will happen. The counter to that is a gap when the stock price is trending up can be it's almost like a catapulting momentum, and you see that actually right there. But the stock price got back to that 200-day moving average, and it hit a roadblock. It's almost like running into a brick wall that you see right here. Once it hit that and did not break through it, it basically was stuck there for a couple of months. It tried to get above that line. The moving average tried to come up and go through it. You can see that it failed to do that. That's a failure. It's still a very bearish condition in the eyes of these institutional transaction people. So anytime you have that gap, think of it as a vacuum and causing this moment, well, literally, it's like not even know what to compare it to. It's a vacuum will be filled. So in this case, just a month or so ago, right after the new CEO took over, and they probably put out some news and some information became known, the biggest breakaway downside gap in the last year happened, and the price dropped a couple of dollars between the close and the open, and it basically created this situation on the right-hand side of the graph. Now, the interesting thing is, it's going to react. It's going to come down. You can see the volume has been actually fairly substantial since that moment in time. That's a whole lot of transacting in this stock after that. And now this becomes kind of another brick wall known as resistance. It would not be unusual for this stock to languish in the upper 50s, perhaps in the $60 range for some period of time. And after it actually breaks through and gets into this vacuum caused by this gap, it could literally be trading sideways for quite a while. And again, not trying to be predictive, just saying, just because of what's actually happening with humans, algorithms, and real dollars, there's a lot of correcting and inertia to be overcome, and very natural for this company to go into a trading range. Okay. Anything you want to add to that, Ken?
Well, yeah, I want to put that last part of the graph into my words so that I can understand what I think might be happening. I think that the stock broke down there. That happened to be very close to when they announced their last quarter, and Value Line told us that the price really broke down. And when it broke down, I think that turned a stock that had been used by a lot of folks as a long-term investment vehicle. I think it created interest not only in the folks that treat it as a great fundamental story and a long-term investment, but it created interest in a lot of folks that deal with very short-term horizons. And they began playing with the stock, and hence the increased volume. There were short sellers that had to cover their shorts perhaps as the price went up in the middle of that range right there, or there were people moving in and then saying to themselves or letting the algorithm say that we're going to move out as the price approaches the brick wall that Mark was talking about, which is the bottom of that gap. Now, there's nothing magic about the bottom of that gap, but if everybody believes it's a brick wall, then it becomes a suitable place to move out when your stock hits the brick wall, especially if you're a short-term trader, if you're going to hold something for a couple of weeks or a month or so. So, of course, you end up with resistance there because 70% of the market is viewing that as a brick wall that's going to be very difficult to break through. Why not sell it and put your money somewhere else where you can find a brick wall where there's a little bit more room to maneuver? I'm not saying any of it's true, but it appears to be happening. And because it appears to be happening, I think it's useful for us to take a look at it and at least note what's going on.
Yeah, and I would second that. We're in this for the long haul. We're going to look at a 10-year chart here in a second. And again, it comes down to the point of this is in the round table. If you're the stock watcher for an investment club, you can now explain why that company is stuck, in this range for a while. And it's not a surprise. And that brings us to point number 3. That's the relative strength index up at the top. It's a fairly good, a very favorable condition when that relative strength index breaks down below 30. In fact, I would say below 20. And below 20 and begins to ramp back up. This is actually a fairly favorable long-term position as long as you can wait out that trading range that's probably going to happen for some indefinite period. So up at the top here, you see this is we've actually circled all the way back to Ann's triple play comment. Yeah, now that it's down here, this is actually a fairly attractive situation long term. And for people who like to trade in this range, it's actually a fairly attractive situation, which is going to account for some of the action that Ken was just talking about. So you can read more about the gap analysis stuff at the address down at the bottom of the page. So again, just to reinforce, we're not talking about really changing anything that we're currently doing. We would like to put stocks on high alert or penalty box type status. What you're looking at here is a 10-year picture of Cognizant. The B's are the times that it's been added to the round table. And you can see that the average cost of our positions is 43. No reason to panic. I do notice that, again, this is a 5-year trailing average of this blue line. Again, forget everything about trading. This is long-term. This is more investment-like perspective. So this is a 5-year trailing average. It is a little bit uncomfortable that this is now on the right-hand side, kind of tickling that, but it's been there before. It's actually touched down here a couple times, and we'll see what happens. But again, it could be a fairly decent position going forward. We just want to take notice of the fact that if it had made sense, and talking about all the stuff that Ken was just talking about, to perhaps come back and think about unloading it at this position in time, again, depending on its return forecast and whether the portfolio needed it. We just want to keep that all in perspective. We did put this chart in here just to show that point in time when the death cross happened just happens to coincide with the lowest return forecast that we've seen in 4 years. On this one.
And what would be really powerful is for us to be able to zip backwards in time about 2 years and re-look at this chronicle graph with that red arrow all the way to the right, and with the stuff that's fallen off the graph being put back onto the graph on the left. If that indeed was a low place for the 5 years preceding this place where the red arrow is, then we're beginning to come up with something that makes some sense to me. I'm looking at a place where the death cross occurred. I love the name, it's so dramatic. The death cross occurred, and at the same time, we're looking at our chronicle and we're saying our par value, even though it was pretty decent at maybe 12 and a half, something like that, our par value is still at a historic low. Now, to make that happen, I'd have to see the the rest of the chronicle, but it's really nice to see that it's the lowest in this 5-year period. That might have been enough to urge me to sell. I wouldn't have gotten out at the highest price. Notice there are some green bars to the right of the red arrow that are higher, but I certainly would have gotten out at a price that's better than it is today. I would have gotten out somewhere, maybe say 73 to 77, and right now it's trading somewhere in the maybe 58 to 62 range. So that's quite a bit of money if you own 1,000 or a couple thousand shares of Cognizant, and it's the kind of triggers, it's the kind of signals that I'm looking for to help me preserve capital. I hated in the 90s when I followed a stock and it went all the way up and then I held it as it came most of the way back down again. I wanted to be able to sell it for some good reason, and I wasn't really good at coming up with rationale for selling something. I know what the problem was. I was greedy. But I'm not so greedy anymore. I'd like to preserve some of that capital, and to do that, this might give me some indication of what's going on in time for me to save some of the capital that has been now lost in Cognizant and might not come back to me for quite a while.
Well, I'm fascinated to hear you talk that way. One, I will build that extended chronicle that you're asking for, so we will take a look at it. And two, I will actually put Death Cross alerts, courtesy of Stock Charts, and I'll post this stuff in the forum so people can see what's going on. So we will actually get bearish Death Cross alerts on the Roundtable, Tin Cup, and others, so that we can at least take a look at this in a little bit more detail, because I do think that there's some potential.
Huzzah!
Huzzah! I did want to point out that many of the people in this audience, you're actually 10 years ahead of this. The Manifest 40, Cognizant joined the Manifest 40 in 2008, so 3 years into it. So the average cost at the time that it actually was added to the Manifest 40 is $854. That's up 21% per year, beating the market by 14.8, even after this downdraft. So I think the shares that you and Natalie bought 10 years prior to that are probably doing just fine, Ken.
Oh, they're a wonderful investment, Mark, and the amount of capital that I've lost compared to the amount of capital that I gained is way lopsided. But at the same time, if I could have saved some of that capital in the last two years or so, it would have been nice to be able to do.
You betcha. So I'm showing, what are we at? We're at 9:25. We've got time for some questions.
Well, let me pull up the question box. I haven't looked recently here.
Now, I do expect to be called a heretic at least once. Hopefully we don't have to block anybody. I will remind people that are scratching their heads about this. First of all, there's been a tremendous change. Second of all, Better Investing had a technical analysis column for decades, and George Nicholson used technical analysis. So there.
Mark, Bill Thompson wants to know, do you have any idea what percent of the stocks have a 15-day moving average below their 200-day average?
I don't, but Stock Charts does.
Okay, so maybe that's something that in a future one of these types of sessions that we can make sure that we get that fact out there, or maybe it can be posted on the Manifest forum. Okay.
Yeah, I'll do some digging and share what I find out.
Okay. Bhaskar, and Bhaskar, if I'm pronouncing your first name incorrectly, please forgive me. But Bhaskar wants to know, what does it mean to be a triple play? And Mark, can you just go over those three ideas to have a triple play and where that came from?
Yeah, it basically comes from some thinking that George Nicholson had done back during the recession around 1974. And he was actually describing a practice that he had had since the 1938 huge correction / depression in the stock market. And what Nicholson found over time was there's two things that he knew to count on when it was really bleak and when the recession was in full progress and perhaps even beginning to subside. One, always, always, always pursue smaller, excellent companies and just ratchet it up during those times. The smaller, nimble companies come out of recessions and recover very nicely. So you want to find them then. And then he also described this condition of the triple play. And the three items are a stock that is on sale, in other words, either a depressed stock price, as we see here that Ann pointed out, the stock price is depressed compared to where it historically has been. The returns are elevated. The average return on a stock right now on this value line indicator is about 6%. So 15 to 24 is significantly above that. And then you're looking for a stock that has a current PE ratio that has the potential for expansion. So the 14.9 up here compares very favorably to this 22 in the 3 to 5 year forecast. So that's a potential for PE expansion. And last but not least, the opportunity for profitability to stabilize and improve. And that's where this one is a little bit weak, as we covered a few minutes ago. A company that has probably got an average net profit margin historically of around 15%, has a 3 to 5 year projection of 14.5. So that one is kind of lukewarm as a third condition. But looking for those three things, when you can find them, and including this one for margin enhancement, we have case study after case study of companies that have actually delivered on this Nicholson potential.
Okay, Mark, Ann Manning has noticed that on the very last chart that you did, the two lines didn't cross, and she wants to know why they didn't cross. Back one more, I think. There, the long-term one right here. The blue line didn't come back down, and I think it's because those are two different averages. Am I right?
Yeah, on this long-term perspective, the blue line is a 5 year trailing average, moving average, same thing. The red line is a 12-month or 1 year moving or trailing average, and they have not yet crossed on this long-term chart. It's a different metric. They crossed here, and this was an extremely powerful, this is the opposite of a death cross. This is the opposite of a death cross back here. It's when the more volatile shorter-term average crosses the longer from the bottom side. That's kind of what Bill Thompson was getting at. He wants those. So do I. We want to identify those also, perhaps, because it was the beginning of a very powerful move to the upside for this company. So it hasn't crossed over. Maybe there's two levels of penalty boxes. I don't want to get complicated, but you know, it crossed on the short-term perspective that all of the institutional traders are looking at. It's still intact here. So maybe that is also something that we need to think about. What would that mean if this moving average on this chart crossed over on a much longer term perspective? We can take a look at a few companies and see if we can derive anything from that.
Okay, we have a comment question from Marianne, and she says that in the online tools, she can get to big charts. And they show where price is in relation to different moving averages. Are most of the picks that Hugh makes under these moving averages? And I would suggest that it depends on which moving average you're actually looking at. Mark just indicated that you can make a moving average over almost any time interval that you want. I do know that Hugh's picks are usually for larger, more established companies. He's looking at absolute price near the 52-week low. And for smaller companies, he's looking for absolute price near the all-time low. So I would suggest that they probably are under most of the moving averages, but I don't know that for a fact. Mark, can you add anything to that?
No, I would just second that. He does definitely shop for vetted companies that are relatively high quality. but he does like to get them within 20% of their 52-week low. And that would be, there's only two candidates on here, DXC and Cognizant has actually come within 20% of their 52-week low. So he does like to shop for them down in that mode.
Joe is giving us a wonderful name for the other kind of cross, and it's called a golden cross, Mark, rather than a death cross. Okay.
We'll take that. Is that an actual industry vernacular, Joe?
Well, I'm suggesting that that the way he wrote the comment, I think it probably is.
Okay.
Mark, I'd like you to make a note to yourself to engage Dennis Roman offline. He has some interesting ideas about quality and a different way to perhaps measure it, and maybe you can engage him in the forum or something along those lines. Okay.
Fantastic.
Bill Thompson says, notice that the RSI moved to overbought at the point where 12-month cross, let me get this reading correctly here now. I just lost it. Where the 12-month cross going up over the 5-year moving average. Do you find a stock more attractive if it's at a 3-year, 5-year, or a 10-year low? I think, oh, that's a different person's question. Bill is just saying, notice that RSI really has some things that kind of correlate to the crossing of what's going on in various places. And Mark Johnson is the one that wants to know from you, Mark, do you find a stock more attractive if it's at a 3 or a 5 or a 10-year low?
Yeah, I would agree. I mean, the stuff that Hugh has done, what he typically does is takes a stock that is more volatile, and he uses a 3 or a 5-year low instead of a 52-week low. And then we've written about that. I can include that in the show notes also. And that just makes a lot of sense. He's just building in a deeper requirement for a stock that has more price volatility.
Hugh does make the point, Mark, though, that in order to make his short list of stocks that he's following for price volatility, he wants a company that he's reasonably certain is going to be around in the next 4 or 5 or 6 years. So he doesn't just automatically look for these low prices, but he looks for low prices on a selected list of stocks that he tends to follow.
Absolutely. I mean, names on his short list are things like Bristol Myers and Lilly, and you get the idea.
Yeah, he's just not pulling up a list of all the 52-week lows and saying, I'm interested in these stocks. That's just not that simple. So we have Sharon wanting to know, is this something that I can find on Schwab.com? And Sharon, you'd have to be a little bit more specific on what you mean by this. If you're looking for some technical analysis instruction, I'm sure there's information on Schwab.com. I know there is because I've read it. If you're looking for a little bit more explanation of some of the terms that are involved, that's available on Schwab.com as well. But I don't think that they have tools that will allow you to draw some of these graphs. Or if they do, they're not as sophisticated as the big charts or stock charts tools that you can also use for free on the web. Mark, Dan was concerned about that 22 PE that Value Line called for 3 to 5 years in the future. Any idea why it's such an aggressive call?
I got to say, no, I don't know why. I mean, we do a lot of mathematical trending and analysis of Value Line's algorithms, and this one doesn't match up like consistent with our experience.
Yeah, I'm worried about it just because it's higher than any of the other PEs in the sample. Yeah. It's, you know, and for a company that's having declining sales rates and having some trouble with profit margins, to end up with a PE higher than almost anywhere it's been in history, that's really a little concerning to me. So
Yeah,
uh,
I think the graphic shows it pretty well. I mean, I eyeball that, and I just have to say, there have been many other times when I would look at the value line projections for net margin or something like that, and I would think, what are they smoking? And then on closer inspection, when you really looked at the long-term trend, they were just fine. I don't find that to be the case here. I could be wrong.
Okay, Joe Farrell is also saying to the people that are looking for more explanation of some of these technical things that he has good luck on YouTube, and I would just say that do everything you get off of YouTube with a big grain of salt, and if you are lucky enough to find somebody that has some credentials doing something on YouTube, tend to give them a little bit more thought than you might somebody else. This Ray Rondo does a lot of writing and a lot of work for AAII, and perhaps his material is available somewhere. Mark, do you know?
Yeah, if you go ahead and Google that, you will find some of the stuff. I know many of our people are AA members, so they can obviously access his stuff. He's putting together a series for the association. But I did find a fair number of things. He just had an article published in Kiplinger's not too long ago. Yeah, there's stuff out there. I'm pretty sure he's got some stuff on YouTube. He's pretty engaging, and he's president of their Massachusetts and New England chapter, so that I will be with him in Boston in a couple of weeks, and we get to continue some of these discussions. Maybe you'll have some pointers for all of us.
Okay, Mark, I've covered the question box. I don't see any hands in the air. Here's where Mark and I and some of our friends are going to be in the next coming throughout the summer and well into November. So if we're anywhere close to where you're going to be, come join us, especially in Oklahoma City. Mark and I will be together there, and that it always proves to be one wonderful session. So in the middle of August in Oklahoma City, if you're anywhere near, come and say hi to us. We're also going to be doing the Mid-Michigan Stock Pickers Breakfast in the middle of November, and Mark and I are going to be in Seattle together this year in November as well. So if you're anywhere near, come and join us. If you're not near enough, then come to the round table, come to our topics, and
Or invite us
sit
to
back
come.
and enjoy yourself.
If you're from either Punxsutawney or San Antonio, we need to hear from you.
So we can be invited, is that what you're saying?
Absolutely.
All right. Okay. With that, the question box has remained empty, and I don't have any hands in the air. So, Mark, thanks for a really good session. Folks, thanks for coming tonight. We appreciate your attendance, and we'll see you next month.
Thanks, Ken. Good luck,
Bye-bye.
everybody.